All right, guys, highlights for this particular day. You're looking at the NASDAQ. This particular day, it's relevant whether you're hearing it on the day it's actually happening or in the future, because there's always going to be days like today where you gap open lower to start it. Some weak stuff came out of the weekend. You got to know what the weak stuff is, and the fact that there was like a perfect storm of a few things that were weak. And I'm not going to get over those, but we're down 1.5%, which is pretty big coming out of the weekend. All this uncertainty is thrown in the market. You have to understand that uncertainty is one of the worst things for a stock market. They'd rather know the details of something bad than the uncertainty of something that it might end up good. So we're weak. And one of the things that was important at the beginning is the downside's the right side. We could rally a lot and still be weak. We get a good sense of how far we could rally after the open. And if we can't and it starts to come off hard, that's the best that the Bulls could do on a gap open lower type of session that we were involved in. Now, what's really important is to watch other markets, but it's even more important to watch other markets when the tempo picks up. And when you have a big range day, a lot of volume and a lot of volatility, the tempo's picked up. So if you're a NASDAQ trader, you watch the NASDAQ. But if you're an S&P trader, you should still watch the NASDAQ, among other things. The NASDAQ gave a ridiculously good clue to when there's going to be downside. So you could have the right direction as a trader or investor. But if your win moments are bad, you're not going to have anything to show for it. You could be right and lose money a lot. So when do you get long? When do you get short? That's about location. That's about timing. So using ancillary or correlated markets is important. There was this big drop at just over 9 central in the NASDAQ, and it led the S&P to the downside. And I told people, hey, if you were looking to get short the S&P, that was the time. This is the time that you got to take advantage of selling it and putting yourself in a position to get to have it go your way sooner rather than later. That's always the definition of a good location. A minimal amount of heat, it starts going your way sooner rather than later. It's really the definition rather of a good location in a more volatile market. It's even more important to get price to go your direction sooner rather than later of opening the position. You could see the tempo picked up a lot right inside that circle. That's why this red line was shot out, and no coincidence it holds to the tick. That's hard to do in the NASDAQ, to hold to the tick. But that's all my edge zones show, these reds and greens. It shows where the tempo picks up. If it's red, the tempo picked up to the downside. If it's green, like in here, the tempo picked up to the upside. Try to keep it simple. And I like them when they're drawn across a little bit, not necessarily when they're short like that. But anyhow, that's a video for another time. The point of the matter is this particular sequence where it broke from 13 to 93 like in a second was your sell the S&P if you're bearish, get the hell out of the S&P if you're long, because the downside's the right side. And then this continuation, which is a lot, certainly isn't a surprise because how quick it kicked lower in there. So you have to be on it. And if you're not on it, be around people who are on it. It's not important to be part of a community. It's important to be part of a community with more eyes and ears on stuff that matters, not nonsense on 1,000 different market and volume profile levels, not nonsense about, you know, uh, things that don't matter. There's so many things that don't matter in trading that people talk about. It's just a waste of time. So you want to be around people who have eyes and ears on stuff that matters. So if you look at just after 9 o'clock, the beginning of this big sell-off was right in there. No coincidence, led by the NASDAQ. Faster markets are moving, the better that watching correlated markets help. When something happens fast, there's generally some inefficiency to follow the leader. And there's no coincidence that while we didn't have an edge zone come out, it stopped right there, based on the speed picking up on the way down in this market. But again, we left this area because of the NASDAQ. And here's this area. You could even draw a little box within the box that we called it. And it left both of them right in there. That's why it come back to there without coincidence. But the downside was not the right side for any kind of, oh, it was a good guess. Your timing, when consistent, are not good guesses. They shouldn't feel like good guesses. They should be stacked skills that you developed over time, listening to the right people, watching the right stuff. And when you miss it, you minimize how much you miss because you're around people who will make you aware of what's going on. Hey, look at the bonds, look at the NASDAQ, look at the yen, the dollar's strong. Did you hear this story? That story came out. This person's on CNBC. These are the things that matter. In a prop firm, the desk-to-desk banter was where I did 90% of my education, listening to how people get frustrated, nervous, angry, look at the bonds. This is helping a squawk that comes off over the office. I mean, those are the things where you accelerate your experience. And that's what's missing in this industry, because you're not going to get that from a book. You're not going to get that from a bunch of YouTube videos. You're going to get that from being around people and just listening to the industry speak, eyes and ears on more stuff that matters. That's always going to be the right education. In an industry with so much fluff and so much BS, they all have it. Every industry has the fluff and has the BS. Trading education is no different. How do you strip that out? You just got to listen to people that seem to make, you know what, this guy makes sense. Talks about things that obviously matter when you value the price of cars and plane tickets. Why wouldn't I watch other markets when I trade the particular price of a market that you want to value? Of course you would watch other markets. Lead, lag, strength and weakness. How do you determine it? You got to compare it to something. Like I've said before, if there weren't, if ugly people didn't exist, there'd be no good looking people. So everybody has an important role. Keep yourself safe. Understand what's driving. What's the theme of the market? It changes. Changed a bit over this past weekend. Know what it is. Stay on top of it. And then subscribe to the YouTube channel.